Hello everyone. Today I am going to provide you with an overview of MCX Natural Gas from PhillipCapital India. So last week we have recommended the view that the bias is down trading below 700 mark in natural gas for the coming week of 8th and 12th of August. So this view was recommended as on 8th of August for the coming week. Natural gas at that point of time was trading at 642 and we have recommended that the bias continues to be range to down trading below 700 mark. And as we can see here on the charts, it has made a kind of triple top on the daily charts at around 760 odd levels and thereafter slipped down. Meanwhile, last week it ended almost at the silver line or tug of war zone at around 640 odd levels for bulls and bears. So we have recommended that dips towards 600 odd levels can witness some kind of buying interest, while on the flip side, move towards 680 to 700 mark can be looked for selling pressure. So buy on dip and sell on rise with positional negative bias below 700 mark was the outcome. As per the write-up which we have mentioned that technically one can hold range to down outlook within a broad trading band of 540 and 700 from the coming weeks on the lower end. So positionally, we have a negative outlook over natural gas. We expect that the volatility will be high and the pullback can witness fresh selling pressure on the higher end. Now, if we see how things have panned out last week, then last week natural gas ended at 698 in line with the view. It has witnessed initially a dip towards 600 mark and thereafter a bounce back towards 700 odd levels was seen in natural gas. So last week it ended up 8.7% at 698 and as we can see here on the charts for the coming week 660 will be important crucial level for bulls and bears. Dip towards 660 initially can witness some kind of buying interest, but at the same time on the higher end 720 will act as a resistance followed by major resistance of 780. So this being a high beta counter driven by geopolitical triggers, the volatility can be high, but these levels are very important. So initially for this coming week, 660 can be looked as a tug of war between bulls and bears. Holding above 660 levels, the bias will be range to positive with a potential immediate target of 720, where short will be activated. Once it hold above 720, it can give an extension leg of up move towards 780 odd levels, which can be again looked for contra trading shorts, keeping strict stop losses. So as per the write-up, we have mentioned that the bias continues to be range to down, and positionally we believe that over a period of time, it can reach down below 600 odd levels. In respect to the strategies which we have recommended, these were the positional strategies which we have initiated as on 3rd of August in natural gas as well as in crude oil, where we got the opportunity as per the price study. So as on 3rd of August, when natural gas was trading at 622 odd levels, we have recommended that there can be a range to pullback outlook in natural gas. Reason being, it was trading in oversold zone. So we have recommended a strategy where we have sold in the money put, that is 700 put of 24th of August expiry. At the same time, we have bought 620 put of 24th of expiry in the ratio 1:1, where the break even was at 650 odd levels. That means closing over and above 650 as on 24th of August would have given a profit in this strategy. The maximum profit was over and above 700 levels. In line with the view, we have seen a pullback in natural gas in the last couple of weeks. And as per the previous week closing, we have got these closing rates where the strategy is in plus of 26,563 per lot. So we believe that the bias continues to be pulled back, but 700 on the higher end will be important level, 720 levels. Any closing over and above 700 for this strategy will be the maximum profit of 66,000 per lot. On the other hand, we have also figured out some opportunity in crude oil, which have been trading in a oversold zone. So as on 3rd of August, we have recommended a bearish strategy covered call covered put, where we have recommended buying in 7600 put. We have sold 7200 and 6800 put in the ratio of 1:1. We have written out 7200 as well as 6800 put because we were expecting that the downside is capped and there will be a kind of pullback but the bias will be overall positionally down. In line with the view, initially crude oil slipped down below 7,000 mark before bouncing back towards 75.50 odd levels last week. Last week, crude oil closed at 7,360 levels, up 3.8%, and this strategy was in a profit of 11,600 mark. As per this strategy and the expiry of 17th of August, closing below 7,400 mark for crude oil would have given the profit in this strategy, and the maximum profit would have been at and below 7,200 mark expiry. Thank you very much for giving your precious time. If you find our content is relevant, then kindly get in touch with us with your queries and the future outlook and reports in respect with natural gas. Thank you very much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.